where does that leave you if you're either a business owner or you're advising a business owner? And obviously, this is this diagram I've had for years. Really, the idea here is that you sell on the upward curve. You can see there, we're leaving something in it for the buyer. Hopefully you don't get to the point, or the business doesn't get to the point with a dotted white line that goes down, in which case you will probably be needing to see NEV, because that's the business is starting to trend the wrong way. And therefore the idea is to try and pick that time. But market's not the only issue. So I spoke at an economics seminar recently, and actually Stuart referred to it. And we had a Bank of England speaker who had lots of very interesting diagrams, but I thought mine was better actually. So I've put this chaos slide together with overlaying that point, the perfect point for the company. You've got to look at other factors. So you have the sector side, the red, each sector will have its own cycle. Our owners reaching retirement age, the green line is the energy levels, and then actually trying to pick the best time there is quite difficult. But yeah, you need, again, take advice early as to when that point might be. And I think, as someone was telling me, in terms of personal investment and everything, you can't always just pick the market. Sometimes you just got to do it when it's right, when it's the right time for you. How do we go about deciding when and how much do you want to get for your business? The starting point for most of the conversations I have with my clients is the valuation of the business. I would say over 35 plus years of selling businesses, I've only 2 or 3 times had to tell somebody their business was worth more than they think it is. So most of the time I'm delivering bad news regarding the value of the businesses. By the time they reach us, they may well have had all sorts of information fed to them. And there's various reasons, just that they don't understand the multiples, where they've come from, etc., or how the structure of how a valuation mechanism actually works. So we try and get our clients off that sort of mantra and say, well, how much do you actually need? And so we take clients to the left-hand side of this graph. How much is trying to take a strategic and a holistic approach to their affairs, and get them to think about what they need in terms of their personal wealth. All the stakeholders work out what they want, need, talk to an IFA, financial wealth planner, so they can actually do cash flow planning, and then from that they come back with a capital sum that's needed from the business. And quite often that discussion, the output of that can be actually what we were targeting, £10 million. That's what they always wanted, and the mantra is we want 10 million quid. And you go say, well, why do you want that? Do you need 10 million? And actually the number could be a bit lower. And sometimes actually the wealth planning brings better news, because you don't need as much as you think you do when you sell a business. You're probably not going to be doing world tours when you're 100. You're probably going to be in a nursing home, so you don't necessarily spend as much money as you think you might. So once we've got that target number, we can then decide, okay, the business needs to grow. If you do need to get to the 10 million, then how do you get the business there? So there's a whole planning process around organic growth, or do you need to do an acquisition maybe if you can't get there organically? And then the timing point that we just talked about. That's the left-hand side. Right-hand side is all the different exit options. Trade sale at the top of that list is still the predominant exit route for companies. We spend 80% of our time doing trade sales. Two-step exits is a form of management buyout, which I'll come back to shortly. I've got a few slides on that, which is a sort of evolution of a management buyout. IPO, not necessarily very rarely for the sort of owner-managed business at the lower mid-market is going to want to do IPOs. Management buyout is a more traditional buyout where the management team knock on the door of the owners, need to go out and raise private equity and or bank debt and then buy the business. They've gone out of fashion a little bit just due to a lot of those businesses that did those highly leveraged management buyouts ended up failing. And hence the two-step exit is an alternative that I'll come back to. EOTs, employee ownership trusts, that was very favourable for tax purposes, went from 0% to 50%, or 50% of the gain can be treated as zero in the last budget in the autumn. Slightly less favourable, but that's a starting point for a lot of the conversations. A merger, when two businesses come together, no money changes hands, but you're a bigger business, smaller stake, maybe a better exit route. Do that first before you acquire. I did that.